Hi Vancouver, and all across Canada. I'm Tim Hill, your local mortgage broker here in BC. With interest rates making headlines and the economy feeling a bit shaky, I'm getting tons of questions about what's next for Canadian mortgages and rates in 2025. Today, I'm sharing the latest projections, including how Canadian factors and international wildcards like US tariffs could shake things up. Whether you're buying, renewing, or just curious, stick around for insights that could save you thousands. Let's break it down. Let's start with where we stand today. The Bank of Canada held its policy rate at 2.75% on July 30th, after a series of cuts totaling 2.25% over the past year. That's brought inflation down to 2.5% annually, close to the BOC's 2% target. Unemployment steady at 6.9%, but GDP growth is sluggish, putting recessionary pressures on the economy. For mortgages, this means variable rates are 4 to 4.5%, tied to the prime rate of 4.95%. Fixed rates are still in the low mid-fours, some of the lowest we've seen since early 2023. But here in Vancouver, where the average home price is $1.22 million, even small rate changes matter. A 0.25% drop on an $800,000 mortgage saves about $100 a month. Recent US inflation data from August 12th shows headline at 2.7%, below expectations, and core at 3.1%, which could influence the Fed to cut rates, potentially giving the BOC room to follow suit. The next BOC announcement is September 17th, so all eyes are on that. Now, what do the experts say for the rest of 2025 and into 2026? Projections are mixed due to economic uncertainty, but here's the consensus from sources like RBC, TD, and the Bank of Canada itself. Market expectations point to 0.25% cuts over the next year, bringing the policy rate down to 2% by mid-2026. Then, we might see hikes back up as the economy stabilizes. The BOC's neutral rate is estimated at 2.25 to 3%. RBC forecasts no more cuts, holding at 2.75% through 2026. TD and CIBC see one cut to 2.5% by Q3 2025, while BMO and National Bank predict drops to 2% by early 2026, followed by a slight rebound. Why the caution? Canada's in excess supply mode. Supply outpaces demand by 1.25%, which could keep inflation tame. But slow GDP growth and high household debt, especially with 85% of 2025 renewals from low-rate pandemic mortgages, mean the BOC wants to avoid a renewal crisis. Policies like 30-year amortizations for first-timers and insured caps up to $1.5 million are helping affordability. As a Vancouver broker, I'm seeing this translate to steady demand in our market, but if rates drop further, expect a 3 to 5% home price bump by year-end. Interest rates don't stop at the border. International factors are honestly huge. The biggest wildcard? US tariffs under President Trump. Threats of 25% tariffs on Canadian goods could shave 1 to 5% off our GDP, costing up to $69 billion by 2028. This trade shock, the largest in nearly 100 years, could disrupt supply chains, boost inflation, and force the Bank of Canada to cut rates deeper to stimulate growth. The Fed's moves matter too. With US inflation at 2.7% headline, markets are pricing in Fed cuts. which often pull the Bank of Canada along to keep the loonie stable. The USD to CAD is slipping below 1.3750 amid these expectations, bolstering the Canadian dollar slightly. Global growth concerns, like softer oil demand and cooling economies in Europe and China, add pressure. Oil prices are weighing on our energy sector. If tariffs de-escalate, as some RBC reports suggest, rates might hold steady. But if they hit hard, expect variable mortgages to drop below 2.5%. As your broker, I'm monitoring this closely. Vancouver's tech and export ties make us vulnerable. So, what does this mean for your mortgage? If projections hold, fixed rates could fall below 4% by late 2025, making a $1 million home more affordable, dropping payments by $300 to $500 a month. Variable rates might also drop below 4 if cuts accelerate, but they're riskier with tariff uncertainty. For renewals, this is good news. Delinquencies are rising, but lower rates mitigate the shock. First-time buyers in Vancouver benefit from federal tweaks, but the stress test at 5.25% still caps borrowing. Overall, the rest of 2025 looks buyer-friendly, with rates decreasing, though trade risks could change that. Remember, forecasts have about 50% accuracy. Economic crises, like tariffs, can flip the script. In summary, Canadian rates could ease to 2 to 2.5% by 2026, but US tariffs and global factors add uncertainty. Here are my 3 tips. First, lock in if fixed appeals. Grab something certain now, before surprises hit. Second, go variable, with caution. If you can handle volatility, it might pay off with cuts. Third, get pre-approved. Run scenarios with me to stress test your budget. I'm here to help tailor this to your situation. Comment below. Are you renewing soon? Reach out at my email or phone, or subscribe for more updates. Let's navigate 2025 together. Thanks for watching.